What are price channels and what do they mean? A price channel is the range within which the price moves in an upward or downward direction. It is called a channel when there are, at least, two tests of both lows and highs. Logically, a channel represents the market's agreement on a consistent rate of increase or decrease, creating a balance in upward or downward movement. The slope of the channel should ideally be around 45 degrees. As you can see, there are two examples here: an ascending channel on the left and a descending channel on the right. In an ascending channel, when the price drops slightly before resuming its upward movement within the channel, this is called a correction. It is a temporary pullback before the price continues to rise. However, when the price moves back up after the correction and retests the last high before breaking above it, this is called a retest. In this case, the new high is expected to be higher than the previous one. In a descending channel, the opposite applies. When the price moves downward within the descending channels, it is referred to as a retest, as it retests the last formed low. Conversely, when the price moves temporarily upward inside the descending channel, it is called a correction. What are the types of price channels? There are three types of price channels based on their size relative to the overall price movement. Major channel. This represents the overall trend of the movement. Professional traders always trade in this direction. The midline of the channel typically has multiple tests, which confirms the accuracy of the channel's formation. Medium channel. This reflects the recent price movement and helps identify areas for potential trade entries in the same direction as the major channel. Minor channel. This is the most important type of channel, as it is always used to draw the price cycle first. It determines the precise entry points in terms of location and timing. Additionally, it signals a waiting period if the minor channel moves against the overall trend. Okay, now how should we draw the ascending channel? What are the conditions that must be met in the price movement to draw an ascending channel? First, you need to identify two higher highs and two higher lows. After that, select the parallel channel tool. Observe the highs and lows carefully, then draw the channel intuitively. I don't want you to worry about not getting it right the first time. Just draw the channel and place it on the uptrend. That's all you need to do. Now that we have drawn the channel, we need to adjust it to fit the ascending price movement. Look at how to make it an ideal price channel. Do you see the upper trend line of the channel? It perfectly touches the two highs, and the price stops at this upper line and retraces every time it touches it. The candle closures should be below the upper trend line of the channel and above the lower trend line. Don't worry if the lows do not touch the lower trend line. The reason for this is the weakness of the sellers and the dominance of the buyers. That's all there is to it. However, you might also find the opposite, where the lows do touch the lower trend line and retrace each time they reach it. Just make sure that the highs and lows respect the trend lines. Alright, let's move on to another channel. Do you see this one? And this one? And this one? These are the corrections, which are temporary price declines. And these price increases after each correction are retests of the previous high. But how does this happen? To understand, I want you to go to the tools and select the rectangle. Then adjust the rectangle to make it narrow, acting as a highlight or a marker for the peaks within the channel. Now, After doing that, look at the price movement after the correction. You'll notice that it breaks through the market area or rectangle to form a higher high. Observe the strength of the candlestick. The body is large, resembling an engulfing candle, which indicates strong buying pressure. Do you see the second low that formed after the correction? It is at the same level as the first high or very close to it, which signals a good buying opportunity. You can remove the path for projections after the analysis. Now let's copy the rectangle. Press Ctrl+V to paste it and place it on another high. You'll notice that the price failed to break through the second rectangle. It attempted once, twice, and on the third attempt it took more time since this is the daily time frame, meaning each candlestick represents a full day. The price moved sideways before breaking through. However, immediately after the breakout, the price took a downward direction. I want to draw your attention to something. Do you see that small peak? It is at the same level as this low. A technical analyst must be highly observant when reading the charts. Now, let's delete the rectangles. Do you see those retests or the three waves? You will notice that the first wave is longer than the following two waves. This is the second wave, and this is the third wave. Now, let's select the Path tool. Next, we want to compare the second retest with the third retest, or more precisely, the second wave with the third wave. Now, let's draw the Path tool with the same length as the second wave and compare it with the third wave. You will find that the third wave has reached the same height as the second wave. I want to draw your attention to a key point. Historical price movements are very important, and price behavior in the present is often quite similar to that in the future. All right, let's select the tilted rectangle tool and place it on the first correction. Now let's change the color. Or choose a distinct color that you like. After that, we will copy and paste it to compare it with the second correction. You will notice that it matches the first drop or closely resembles it. You should remember a key rule. Prices do not always repeat with 100% accuracy in the future, but they typically show a similarity ranging between 75% and 95%. Now, let's copy the third one and place it on the third wave for comparison. You will find that it matches perfectly, doesn't it? All right, now let's assume you have two peaks and a trough, and you have a clear trend, which is an upward channel. As you can see, there is a peak, a trough, a second peak, and a trough about to form. How can you predict the upcoming price movement? This is considered a relatively long wave, and you're not sure if the second wave will have the same length. There's a smart method. First, you need to mark the peak using a rectangle or a horizontal line. Ensure that the first trough is at the same level as the peak. After that, we will identify the buying zone after confirming the formation of the trough or the completion of the correction before the retest. This is our buying zone, and this entire area is considered a buying zone. This indicates the completion of the correction and that it's about to retest. To estimate the next wave, you need to identify the first correction using an angled rectangle. After marking it perfectly, copy it and move it to the prediction area. Then flip the rectangle so it matches the shape of the anticipated upward wave. As you can see here, the prediction area or the prediction rectangle approaches the channel ceiling or the upper trend line of the channel, which validates our prediction, doesn't it? Now, let's set the sell target and revert the chart to verify. As you can see, our prediction was successful in a logical way, and price movements tend to resemble their future behavior. I will share a secret for successfully trading channels. Do you see the three waves? After identifying three waves, expect with high probability that a reversal phase toward a downward movement is about to occur. Look at this drop. It aligns with the level of the first trough. Here's the easy method. Take the path tool and count from the first trough. Observe the first impulse. And the second. And the third. After the third wave, you should anticipate a decline and the reversal phase.